Good morning, everyone. I'm going to give it a few minutes to let the participants load up here. Definitely, I'm noticing these Zooms are highly effective, but when we set up these presentations, they take a few minutes to let all of the attendees join in. Just wait a couple more minutes here. All right, it's kind of leveled out. Good morning, everyone. My name is James Bogart, Managing Principal of Bogart Wealth. Before I get going on the topic today, which is going to be talking about the Secure Act and your retirement, we do have a question and answer box as well as a chat function. I've got both of those up. I believe they're listed at the bottom end of your screen, but I have both of those up. If you'd like to ask questions along the way, I'm going to do my absolute best to answer them real time. But at a minimum, I will make sure that I answer them at the end of the presentation if I missed them during the talk. So we're Bogart Wealth. Bogart Wealth is a registered investment advisory firm, fully independent. Clients that we work with have their assets held at Charles Schwab. We are true fiduciaries for our clients. Bogart Wealth's core areas of competency are financial planning, investment management, and tax optimization. There are actually now 15 of us on our team, about to be 16. We've got a new person joining us in the Woodlands at some point when COVID-19 calms down a little bit. We have 3 different offices, one in McLean, Virginia, one in Houston, Texas, and then one in the Woodlands, Texas. You know, our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. We commonly will say your kids and your parents can be some of the largest variables of anyone's financial plan. We've made it part of our firm's culture to give your children access to our certified financial planners. You know, the typical question I like to ask is, you know, what would you do differently now that you know what you know, but maybe back when you're in your 20s and 30s? And there's a lot of things that we can do to help the children of our clients. So we've been actually doing a lot of these webinars. It's part of what we're calling our retirement cash flow optimization plan. We do have 8 staple ones that I'm going to now start doing more consistently. I am going to commit to doing one a week starting in May. Different topics, whether it be the retirement planning timeline, or retirement income planning, Social Security strategies, tax planning, tax law changes, estate planning strategies, talk about net unrealized appreciation and post-retirement strategies, one on long-term care and long-term care insurance, one on Roths versus traditional 401ks and IRAs. We're adding some new topics. We're obviously trying to make these as timely as possible. Today's obviously a different topic. We're going to talk about the Secure Act. But if there's anything that you would like us to talk about or think that it would be worthwhile to talk about, we're more than happy to present on it. And please feel free to either send me an email or send one of my team members an email, and we'd be delighted to, at a minimum, incorporate it in an existing talk, but potentially even look at doing one all on its own. All right, so today we're going to talk about the Secure Act. It actually stands for Setting Every Community Up for Retirement Security Act of 2019, or HR 1994. Now, it was actually introduced to the House March 29th of 2019. It passed the House Ways and Means Committee April 2nd, passed the House May 23rd, but ultimately it died. A lot of that had to do with some of the political environment of 2019, but it did get revitalized right at the end of the year. So it passed the Senate on December 23rd, 2019, and it's going into effect for the 2020 plan year. We're going to talk about the main implications and how it impacts a client, and I'll get into some of the secondary nuances of the Secure Act, but there's some good stuff and then there's some less than good stuff. So the good stuff for the most part is talking about they moved the required minimum distribution age from 70.5 to age 72. Now, for anybody who doesn't know what the required minimum distribution age is, that is the age at which the IRS makes you start taking money out of retirement accounts. Retirement accounts, specifically talking about traditional IRA accounts, traditional 401k accounts, as well as Roth 401k accounts. Now, the one that I didn't list is Roth IRA accounts. So for any active employees who have have Roth 401ks, it's important to know that even though you got the money in there tax-free and it's supposed to grow tax-free, if you leave it in a 401k as a Roth 401k, it's going to be subject to the math for required minimum distributions. Now, specifically the rule change, it applies to those who had not attained the age of 70 and a half prior to December 31st, 2019. Unfortunately, if you had already reached the age of 70 and a half and had not quite taken your first RMD yet, because you do get to defer it until April 1st of the following year, unfortunately, those individuals don't benefit from it. So it's specifically timing benefits of those that were born March 1951 or later. Now, there is no change to life expectancy tables of a 72-year-old RMD calculation. I'll talk about that more in a second, but nice little graphic here that just shows essentially what it did was it moved the trigger age out. So for anybody who had not been taking RMDs yet, if you were under the age of 70 and a half at the end of December 2019, the new RMD age for you is now age 72. Now, here's just a real quick slide on what the required minimum distribution tables are. And basically, what they did was they previously had started at 70 and a half, and the initial withdrawal rate was 3.6%. And now they've essentially moved it out to start at 72. And so now the new withdrawal rate is 3.9%. Now, however, this is we say old distribution. It's actually based upon a current proposed change. And they're actually talking about adjusting the RMD table. They have not officially passed that yet, but it is on the table. And I imagine because of COVID-19, everything has kind of just been pushed back a little bit. I anticipate it will pass ultimately, but in the near term, for planning purposes, we have to assume the current one, which is the one, I guess, in orange color on the left. But the right one is ultimately where they're headed. Now, one thing that's important to talk about with this required minimum distribution percentage, what they do is they look at the value of your IRA accounts as of December 31 of the previous year, and then you divide it by this life factor. And this life factor, again, is set by the IRS. Now, ultimately, that life factor is then what determines this percentage. Now, if the IRA accounts are continuing to grow, you'll obviously at a baseline still see that percentage staying the same. However, this life factor actually declines every single year, which causes the percentage of your required minimum distributions to increase. So for example, if you're fortunate enough to live to 115, your RMD in that year is 52.6%. So because these percentages are increasing, it typically creates an environment for those that are fortunate enough to have larger retirement accounts, that those required minimum distributions increase every single year, causing the taxable income to go up every single year. Now, naturally, with them pushing the RMD start age out by an additional year and a half, it gives a little bit of additional time to be able to do a little bit of tax optimization planning and talk about, kind of long-term holistic reduction of the RMDs. And we'll talk about those in a little bit here. All right, so that's the good part. That's pretty much the predominant good part. There's a couple little nuances that are pretty good, but there is some pretty big negatives, in my opinion, associated with the Secure Act of 2019. And the biggest is really what I would call, or affectionately grown to call, the death of the stretch. Now, what this means is prior to the Secure Act, your heirs were able to inherit your retirement accounts, and then they could start taking required minimum distributions over their life factor. So I go back to this table here, and actually the table goes to significantly younger ages, because if, let's say you have a 20-year-old who inherits a retirement account, well, obviously the percentage that they're going to have to take out is significantly smaller than somebody who's 70. But ultimately, your beneficiaries were able to inherit retirement accounts and stretch them out over their lifetime. Now, unfortunately, that's no longer the option. The option now is categorized based upon three different categories of beneficiaries. What we call as eligible designated beneficiaries, and these are minor children of a decedent, disabled persons, chronically ill, anyone that's not more than 10 years younger, certain trusts, and certain spouses. That's one category of beneficiaries. Another category of beneficiaries are what they call designated beneficiaries. So this is certain trusts and anyone non-spousal that is a beneficiary of a retirement account. And then the third category actually didn't have significant change, which is what we call non-designated beneficiaries. These are certain trusts as well, charities, and your estate. Now, when we say your estate, that means that you did not list a specific beneficiary designation, and ultimately those series of rules are going to apply to them as well. All right, so let's dive into this a little bit. So it is going into effect as of January 1st, 2020, except for certain governmental plans will wait until 2022. Now, it is all based upon the date of death of the owner. So if you had somebody who passed away at the end of 2019, it's important. January 1st is the effective date here. Now, what it did was it eliminated the stretch, as I was already discussed, over a beneficiary's lifetime for designated beneficiaries, that middle category. This group of people is now required to take out the entire balance of retirement accounts. And again, retirement accounts are defined as an IRA account, a traditional 401k account, a Roth 401k, and also a Roth IRA. They have to take out the entire balance of the retirement account within a 10-year period of time. Now, it's not required to take out any RMDs for the first 9, so ultimately you could actually push all of this out until that 10th year and have all of the money come out at that point in time. But for IRAs and traditional 401ks, if you remember, that was pre-tax money that went into those accounts, and when it comes out, you have to pay ordinary income. Now, from a planning perspective, let's just say that your heirs are going to be very fortunate, that you're going to be leaving them significant portion of your wealth is going to them in either an IRA or a traditional 401k. Let's just say it's $1 million for illustrative purposes. At a very basic example, if they wanted to take out over a 10-year period of time, $100,000 a year, well, ultimately, sure, that might benefit them, but at the end of the day, it's coming out of that tax-deferred environment and moving into an after-tax environment. Along the way, they've got to pay the tax bill. And let's just say that if your kids or your heirs are inheriting these, more commonly, it's at the later stages of their earning careers. They might be at high income brackets themselves. And then all of a sudden you tack on an extra $100,000 of income in that example, you could potentially be exposing your retirement accounts to significantly higher tax brackets than you're in today. Another little quick nuance here is you could potentially squeeze in an 11th year if you take out an RMD in the year of the person's death. So for example, let's just say someone passed away in January. Well, technically the way that RMDs are structured on inherited accounts, you're not required to take them out for the first year of death. You have to take them out starting the year after, or that 10-year clock will start. But if someone passes away in January, you theoretically could do one there in that 11th year, and then have 10 preceding years to take them out after that. All right, so some exceptions to the new rules. Well, surviving spouses, nothing impacted there. Surviving spouses still have the option of leaving it in the participant's plan. They could take RMDs out based upon the original participant's birthday. They could roll it to their own IRA account, or they could ultimately take the whole thing out if they wanted to. I don't know why that would make sense, but they can. They also did not change the rules for minor children of the decedent until they reach the age of majority. Now, critical thing here is age of majority is defined by the age of 17. So anyone who is over the age of 18, they're no longer counted as a minor child. And now all of a sudden, the 10-year rule would apply to them. And it absolutely cannot be grandchildren, which would be kind of difficult to get that age math, but I mean, we do see it. All right, a couple other people that were excluded from the new RMD rules, chronically ill persons, disabled persons, and then anyone that's not more than 10 years younger. So it could be like a brother or sister, sibling, something like that. They don't have to take out over a 10-year period of time. All right, so, and then there was that third category of households, the non-designated beneficiary household. It was that red group when I go back to this slide here. Nothing actually officially changed here because with these types of groupings, certain trust charities in your estate, you actually are required to take the entire balance out over a 5-year period of time. So 5-year, not 10-year. Ultimately, if you have heirs that you care about, at a bare minimum, you want to make sure they're named so that they have the ability to at least use the 10-year window, and it's not just over a 5-year period of time. Okay, now Trusts. Get a lot of questions related to the Secure Act and trust and what impact trusts have had on, or how have trusts been impacted by the Secure Act. Now, the general rule is that they are still, a trust is designated as a non-designated beneficiary, which would mean that it's that 5-year window of time. But a trust can be treated as a designated beneficiary if they meet the see-through trust rules. Certain see-through trusts may also be treated as eligible designated beneficiaries if you have one of these groupings of people who are excluded from the rule. So, for example, if you have a trust as the beneficiary and your spouse is named as in the trust as a trust, and there's a see-through provision, then you're fine. It would the spouse would still be exempt from the RMD rules. Same goes with the kids. The kids fall into that category of designated beneficiaries. If there's what's called a see-through provision, then it does still enable them to fall in that 10-year window of time. Now, ultimately, it's important to talk about structure of using trust as a beneficiary for retirement accounts. And the reason that we talk about trusts as beneficiaries is because trusts are control vehicles. Trusts are not tax efficient vehicles. And that is one of the biggest misconceptions we see with households as we're looking at do we use a trust as a beneficiary of a retirement account or not? Ultimately, it's important to remember trusts are control vehicles. They are not tax efficient vehicles. And the reason we say that is because trust tax rates are significantly higher than individual tax rates. And by the way, I'm actually specifically talking about irrevocable trusts. So a revocable trust is while you're alive, but once you die, it converts over to an irrevocable status, which is where essentially all of these provisions would kick in. Now, an irrevocable trust would, when you pass away, have its own tax ID number created, and then all of a sudden have to file its own tax return based upon its own tax schedule. For 2020, anything over $12,950 of taxable income is actually taxed at the 37% bracket. So let's just use that same example I did before. Let's say that your child inherits $1 million IRA account. Now, if it goes to the child, it's going to be taxed. Those RMDs, the $100,000 a year, is going to be taxed at the child's tax rate. However, if it goes through a trust that's not properly structured, that $100,000 of RMD has to be taxed at the trust tax rate, which, as I just mentioned, anything over $12,950 of income is taxed at 37%. Now, some people say, oh my gosh, that's absolutely not what I want to have happen. I want to minimize the tax burden. Well, in order to do so, unfortunately, it means that you are going to have to alleviate control, which means that the beneficiary designation either needs to be the children themselves, and we're just going to give them outright access to the money, or we use something called a conduit trust. Now, a conduit trust is where we actually are creating a mechanism that allows the RMD to get pushed out to the beneficiary so that they are then, the RMD is then taxed at the beneficiary's tax rate. Now, a conduit trust provision means that we absolutely need to make sure at least the RMD amount gets pushed out to the child. Now, ultimately, every person's trust scenario and what control mechanisms they want to have in place may or may not be stringent enough, and some might be more stringent than this rule. This is where we absolutely need to have a conversation around your estate plan, your household, your situation. All right, a couple other types of trusts to talk about here. Discretionary trusts are generally, they generally will not qualify as eligible designated beneficiary status. So a discretionary trust is one where the trust would inherit the assets, or for example, the IRA accounts, and then the beneficiary ultimately would have the ultimate discretion to be able to qualify for it. So just because it's a discretionary trust does not mean that it qualifies for this conduit provision. And then also the other exception here is applicable multi-beneficiary trust. So let's say, for example, you've got 4 kids. One of them might fall into the category of disabled, chronically ill, some category that would make them an eligible designated beneficiary, which means that they can stretch the RMDs over their lifetime. But all trust beneficiaries must be designated, so they have to be alive. And ultimately, it does lead to some planning complexities that if you have a child that passes away, we need to adjust the beneficiaries in the trust. But at least one of the beneficiaries must be an eligible designated beneficiary. And also, the most important part of this is at death, your death, it has to create a specific trust for each child. And so that would then mean that the child who is disabled or chronically ill would still qualify for the eligible designated beneficiary status. And then the others who are just normal, I hate to say that, that's so insensitive, but the ones that are not deemed disabled or chronically ill, they would then be still required to take the provisions out over the next 10 years. All right. No questions. I'm kind of surprised. But the big takeaway I would say with this is review your trust. If you're going to use a trust as a beneficiary, we want to make sure that we have the appropriate provisions in there. Specifically, there's a see-through trust provision. And then secondarily, if it's appropriate, we have the conduit trust provision in there. All right. Now let's talk about change to beneficiary rules. The death of an eligible designated beneficiary. So let's just say, for example, a spouse inherited the retirement account. The distributions are no longer calculated over their life expectancy. Again, this is at their death. The 10-year rule would apply to all successor beneficiaries. And then all beneficiaries treated as successor beneficiaries cannot be eligible designated beneficiaries. Now, for the second category, the death of pre-Secure Act beneficiaries. So this is anybody who passed away pre-December 31, 2019. So now here, ultimately, the decedent died on or before the effective date. The 10-year rule would apply to the successor beneficiary. So not the beneficiary themselves. So let's just say one of your parents died before the end of the year and you already had taken an RMD, or you already were on the stretched out RMDs. This is talking about the next level. So when you pass away and who you name as a beneficiary, they would have to use the 10-year rule. And ultimately, the successor beneficiaries cannot be deemed as eligible designated beneficiaries. So for both categories, you can't have, for example, your spouse treated as a eligible designated beneficiary on an inherited account. All right, I did have a couple questions come in. Let me make sure I get to these. I no longer have a trust. I have designated my portfolios with beneficiaries. I don't see an advantage to go back and create a trust, correct? Yes. Ultimately, we need to talk about it more high level with your situation. But if it's important to maintain the control, meaning the kids typically have something going on, whether it's themselves, potential divorce, something like that, then maybe we revisit it. But if the kids are responsible and you trust them and the ultimate objective is just to give them the money, then absolutely, we don't need a trust per se. But we should talk about that more one-on-one. Do you manage the trust, or should we arrange with a certified estate planner, lawyer, or other service? So estate planning fully integrates with all the planning work that we do. So we need to have a discussion, household to advisor, to talk about what's appropriate. Now, Bogart Wealth is not lawyers to actually generate the documents themselves. So if the intent is to have a trust to be able to control these assets, we can't legally draft the documents. However, we do all the consulting work ahead of it so that when we go and visit with the lawyer, we know exactly what we're trying to do. And in order to coordinate with us, let's just set that up for our next review meeting, and we'll have that discussion. All right. A couple other changes that happened related to the Secure Act. So this is a good one, in my opinion. Adoption and birth of a child exemption. So IRA owners can actually withdraw money for the birth or adoption of a child without paying a 10% early withdrawal penalty. The retirement annuity plan option. So part of the Secure Act, I've only talked really mostly about the impact to the individual, but part of the Secure Act was really to target companies and incentivize them to offer retirement plans. But one of the options that they also pushed forward was now every 401k plan is required to offer an annuity option. Now, I don't know a ton of participants that want to take their 401k and turn it into an annuity, but it's now required that they present you with those options. It does make it easier for 401k sponsors to offer those annuities as an investment option, and it also provides a fiduciary safe harbor selection for a lifetime income option. It also clarified portability of annuities in a plan, so the Act will make it easier to distribute an annuity from a plan. And then it did choose a significant amount of small business incentives. The Act made it easier for small business owners to join multi-employer plans. They also gave small business owners some tax credits if they hadn't already had, they did not already have a plan established. And then the next one was the 529 withdrawal changes. You can actually now take $10,000 out of a 529 one time to pay down student loans. And we'll talk about kiddie tax laws. Dad actually just clarified a question for me. We do manage assets for trusts as well as inherited IRAs and IRAs, even if the trust is the beneficiary. What I was talking about in terms of execution and establishing the trust, we're not the lawyers to write those documents, but we absolutely are the investment managers on those. All right, real quick, I want to jump over to kiddie tax laws. Now, kiddie tax laws are specifically talking about the taxes that your children would pay if they fall into a certain age category. And now, ultimately, kiddie tax laws were something that were modified with the 2018 tax reform. And then what actually ended up happening is with the Secure Act, they reverted back to what they were. So it's kind of come full cycle. They realized that they made a big mistake with what they had done with kiddie taxes, changed it back. But it's specifically talking about anyone under the age of 19 or 24 if they're a full-time student. And it's assuming their taxable income equals the top of the taxable income range. So they have to do a very specific calculation to see if kiddie taxes are going to apply. It can be somewhat confusing. I'm going to use an example to explain that, but this is essentially what it is. It looks at the child's net earned income plus the child's net unearned income, and then they apply the child's standard deduction, and that's going to equal the child's taxable income. So for 2020, dependent child's standard deductions are greater of $1,100 or the sum of $350 plus the child's earned income if the child can be claimed as a dependent. So here's the example. So if a dependent had no earned income and unearned income, so dividends, interest, and investment income are $5,000. And let's just say mom and dad's income was $170,000 of taxable income. The calculation now becomes $0 of earned income plus the $5,000 of unearned income minus the $1,100 equals $3,900 of taxable income. Then we go back and we say, all right, $5,000 of unearned income minus the kiddie imputed exemption, which is $2,200. So that's going to equal $2,800 of net unearned income. So the $2,800 is going to get taxed. And under the Tax Reform Act, the first $2,600 is taxed at 10%. And then the $200 that's over that first threshold gets taxed at 24%. So they just changed the way the calculation looks along the way. Okay. Now, qualified charitable distributions, QCDs. Now, there is some confusion with qualified charitable distributions and what they now have done with the CARES Act that just passed at the end of March related to qualified charitable donations. So it's important to talk about distributions versus donations. The CARES Act clarified that each person can donate $300 if you do not itemize. This is actually talking about something else, so I didn't want it to get confused. But as we're talking about your IRA withdrawal strategy, you might want to consider contributions through qualified charitable distributions. Now, a qualified charitable distribution is a direct transfer of funds from your IRA custodian to a qualified charity. Qualified charitable distributions can be counted towards satisfying those required minimum distributions for the year. Now, in 2020, because of the CARES Act, we actually do not have to do RMD distributions at all anymore. But this is a strategy that, again, as we're looking forward, we might want to actually consider, because you're able to actually take money out of an IRA account. It goes directly to the charity of your choice or donor advised fund of your choice, and you're able to reduce the balance of the RMD so that it's not actually continuing to increase your taxable income. So the amount that you donate does get excluded from taxable income, and it keeps your taxable income lower, which also may reduce the impact of certain tax credits and deductions as well. Now, to do this, you must be over the age of 70 and a half. Now, remember, we talked about the Secure Act increased the RMD age from 70 and a half up to 72. They did not change this age. They kept it at 70 and a half. So if you're over the age of 70 and a half, you can take money out of an IRA account, have it go directly to a qualified charity. It is limited to the amount of what you otherwise would have as ordinary income, and this excludes non-deductible contributions. So what it's saying is that you can't donate more or take more out of your IRA to go to a charity than what you're actually going to have in ordinary income. Although I will say these amounts are very high. So the maximum annual amount that can qualify for a qualified charitable distribution is $100,000 per husband and wife. So a married couple can send out 200 grand from an IRA to offset RMDs. Now, obviously, you need to be very charitably inclined if that's something that's important to you, but absolutely something to consider. The funds must come out of your IRA by the RMD deadline, which is generally December 31st. If it's your first year of RMDs, you can delay that all the way out until April 1st of the following year. Got a quick question that came in. Can you say again the rules around a sibling inheriting an IRA 401k who is not more than 10 years younger than the decedent? Yeah, so a sibling inheriting an IRA or 401k, if they're within 10 years, they could be counted technically as an eligible designated beneficiary, which means they're eligible to stretch it out. That's one little nuance in there that might actually benefit. But typically, husband and wife, ultimately that's usually the wife's the primary, and so we're satisfying it there. All right, I mentioned donor advised funds real quick. We do believe donor advised funds are an amazing tool because you're able to take cash or highly appreciated stock, place it into a donor advised fund. And then ultimately we can use that donor advised fund as a conduit to pass along to charities. Now, we can contribute cash or highly appreciated securities. You do receive an immediate tax benefit off of the amount that you put in. So a lot of people get confused in terms of highly appreciated securities. Let's just say that we had a stock position that we bought at $10 a share. It's still at $40 a share. You're going to get the benefit of the $40 per share price, not the $10 that you paid for it. It allows you to completely skip out on having to pay ordinary income, or excuse me, long-term capital gains income on the $30,000, the $30 per share of gain, but you get the benefit of the $40 per share price donated over. Same goes for these qualified charitable distributions. You can actually have those qualified charitable distributions go right into the donor advised fund. Now, the thing with donor advised funds is it provides great tax diversification strategies. Most employers still, if they have any type of retirement plan eligibility for any type of gift matching, ExxonMobil being one of them, they still will match coming out of a donor advised fund. But you're able to actually use this donor advised fund. The only requirement is that you have to distribute 5% of the balance each year. Minimum requirement to start one of these is $5,000, by the way. But let's just say you put $5 grand in, you're only required to give out $250 of the balance. But you're going to get the benefit of the $5,000 of tax deduction in the year that you do the donation, which is a great tax planning strategy because ultimately, if we're trying to bring your taxable income down, whether it's because of RMDs or we're trying to go after a tax harvesting strategy, donor advised funds are an awesome tool where we can do a little bit more. We might even, for example, front load 2 or 3 years worth of charitable donations that you might have otherwise have done in order to impact the direct year that we're doing the planning work for. And I think it's a great tool to allow you to have a very simple option to be able to get money to charities. It also allows you to create a charitable legacy. So if that's something that's important to you, you can name the kids as the successors of these so that they can use the money that you put in and you got the tax benefit for to be able to distribute it out. It's also a really simple solution for charities. We have found that there are some charities that, for example, don't have brokerage accounts to be able to inherit or receive stock donations. And so if that's the case for them, then maybe this is one of the options we want to consider, where we could send the money from the donor advised fund right to the charity. They get a check. It's very simple. So if donor advised something you'd like to talk about, we're delighted to have that as part of the discussion. So in terms of kind of wrapping it up to talk about strategies to consider, first and foremost, based upon the Secure Act, we want to make sure we review all beneficiary designations, including especially if we're using trusts. Consider contributing to a Roth IRA via a traditional IRA for backdoor Roth contributions while you're still actively working, because we want to get that tax-free growth. And then also, while we're in younger years, potentially lower tax brackets, consider converting funds from traditional IRAs over to Roth IRAs. We have several presentations on Roth conversion strategies. I'm going to be doing one in a couple weeks as well. I just did one that if you'd like to get the recording for it, please feel free to let me know or any one of the team members know. And then also another strategy in terms of maximizing the transition of wealth to kids We love getting it into Ross because it's going to grow tax-free for the rest of your life, and then it's going to grow tax-free for them for at least the first 10 years. But maybe if you're in the position ultimately where you're giving money to your kids or heirs, go ahead and do some gifting strategies now. Help them while they need it the most, not necessarily when they're in their later years getting ready to retire themselves. Consider qualified charitable contributions. That's one way to help with managing the RMDs. Also consider the donor advised fund strategies. All right, so that really is all I had for today's webinar. One of the calls to action from any of these that we do is if you'd like to sit down for a one-on-one financial consultation, we're delighted to do it. We've got a fantastic team of advisors here at Bogart Wealth. It's absolutely no cost, absolutely no obligation, just something to give you a baseline of where you're at and where your situation is. And if there's anything you need, any questions I didn't answer today, please feel free, send me an email. I'm delighted to help in any way we possibly can. That's all I had for today. If there's any topics you'd like to hear us present on in the future, please let us know. Most importantly, stay healthy, stay safe, and we're here for you. Thank you.